So this is Julia and Arthur. Now, for those of you who have seen our website, you'll know that it's all about showcasing our clients as the heroes of our business. And this is no different. I remember the exact day that I met them. It was Monday, the 11th of February, 2013. And it had been just over a month since I'd become a financial planner, having moved from my previous role as a broker consultant at a product provider. And this was my first client meeting as an authorized and regulated financial planner. I was sitting second chair to the senior planner, who was also my mentor at the time, and we were meeting these relatively affluent prospects who had accumulated a significant retirement portfolio and who wanted to learn more about our services to decide if they were going to work with us. So after the exchange of a few pleasantries, Arthur, who's a rather matter-of-fact kind of guy, asked us point blank the question that was weighing on his mind. He said, "How will you generate income from my investment portfolio in the first place?" Well, you can imagine that having just come out of product provider land, I saw this as the perfect opportunity to tell him all about our investment process. And I gave him both barrels. I mean, I described the way that we didn't just focus on interest and dividends for the income, that we took more of a total return approach with our portfolios, that we used evidence-based techniques to combat the effects of inflation, et cetera, et cetera, et cetera. And after about 20 minutes of me walking him through our investment process for retirement planning, Arthur simply looked at me rather exacerbated and asked again. He said, "Amyr, but how will you actually get income from my investment portfolio into my current account so that I can pay my bills?" To which I answered, well, for all of our clients, we set up a monthly transfer from your personal pension, your ISAs, your GIAs, and that goes straight into your account, and our process ensures that there's always cash available to do that. "Great," he said. "That's all I needed to know. If I wanted to know about the investment stuff, I'll be doing this myself. So now let's get started." Good afternoon, ladies and gentlemen. My name is Amyr Rocha-Lima. I'm a partner at Holland, Hahn & Wills. We are a financial planning and wealth management firm who specializes in retirement planning. Firstly, I'd like to thank the CISI for inviting me to speak here today. It's really an honor to be speaking to my peers about retirement planning, which is a topic I'm so passionate about. And as the story of Julia and Arthur hopefully illustrates, when it comes to retirement planning, we're all pretty much dealing with the same problem. I mean, broadly speaking, our clients have similar goals, they're dealing with similar emotions, but each of our clients have had their own unique life experiences, which will impact their attitude towards retirement. And because of that, I actually think that there's a lot we can learn from each other. So my job here today is to take you through my thinking on building a robust retirement planning process. And it's going to take me about 40 minutes. And by the end of it, I'm going to leave you with 3 things that you can take away and implement in your business straight away. So to start, I think it would be helpful to go back in time and have a look at the history of retirement planning and the evolution that has happened in the sources of retirement income, from interest to dividends to including withdrawals of capital gains and even the investment principal. So in the early days of modern retirement planning, say post-World War II, the solution to the retirement planning conundrum was fairly straightforward. I mean, retirees bought bonds and clipped the coupons to generate the additional cash they needed to fund their additional retirement expenses. And even in the 1950s and 1960s, bonds were still issued in a physical certificate form, and bond interest was paid in the form of a physical coupon attached to the certificate that you would clip, take to the bank, and encash just like a paycheck. So all the retiree needed to do was buy enough bonds to have enough interest-paying coupons so that they could encash to generate the additional income they needed to fund their retirement. And interestingly, I don't know if you can see it clearly because I took this picture with my phone, but this bond here was issued by the Belgian government, and it was owned by one of my colleagues' family. Now, as I said, I'm not sure it's that clear, but you'll notice that the coupons have been clipped all the way up until 1940, when, of course, Hitler invaded Belgium, and this bond became worthless. And instead, his family actually fled to the UK, so probably the better choice in that case. Moving forward, however, the inflation of the 70s pretty much ravaged the purchasing power of bonds, driving a shift towards dividend-paying stocks instead as an alternative vehicle to generate those retirement paychecks, at least in a way that could keep up with inflation. But the essence of the retirement income strategy was substantially the same. You just buy enough dividend-paying stocks, as opposed to interest-paying bonds, to have a regular series of retirement inflows to be able to cater for those additional retirement outflows. And fortunately, a well-diversified portfolio of dividend-paying stocks also typically ended up being a well-diversified series of distribution dates. Perhaps not distributing retirement income as consistently or as evenly as bonds were, but more than enough to be manageable. Now, as this graph shows, the added complication of introducing dividend-paying stocks to the retirement portfolio was that stocks can also produce potentially quite substantial capital gains. And in fact, through the decade of the 1980s, the raw price level of the MSCI United Kingdom, for example, it appreciated over 600% throughout that decade, which meant retirees suddenly had another very substantial source another very substantial source to generate retirement income via the ability of being able to encash some of those capital gains. Except capital gains aren't nearly as stable or consistent as dividends or interest, producing outright gains in some years and outright losses in others. And as a result, while capital gains are capable of generating substantial amounts of additional retirement income, they're far less conducive to a steady approach to generating regular retirement paychecks that will be deposited into the retiree's account. So, the good news is that there's actually a lot more retirement income and wealth potential to be created by navigating the investment intersections of interest, dividends, capital gains, and the investment principle. But the bad news, however, is that it becomes remarkably difficult to simply figure out where the actual cash will come from to be able to generate those regular retirement paychecks in the first place. In other words, the sources of retirement income, when they're unstable, it effectively begins to dissociate from the word income in a traditional sense of the word, and it becomes more akin to generating retirement cash flows instead. Which, to be fair, is probably how the majority of us in the room illustrate our financial plans to our clients in the form of a cash flow plan. So, I guess the one thing I omitted so far, and of course we can't ignore, is the fact that the simplest, most straightforward solution to generating steady retirement income is simply to buy an annuity. But, if retirees want to maintain some form of liquidity or have a desire to leave behind a legacy, or even for that matter, want to participate in the potential upside of markets, even though they know this entails a risk of participating in the downside, it becomes necessary for them and us to use, and more importantly, to figure out how to use a more diversified investment strategy or investment portfolio. Which brings us back to the initial question. How should retirees and us, their advisors, generate regular cash flows from an inconsistent investment portfolio in the first place? Well, the first option is to use a more traditional income-based investing approach. And this is pretty simple. I'm sure most of us have done this in the past. It's simply to invest in vehicles that produce a steady stream of cash flows in retirement via the payment of dividends and interest. So buying a combination of funds, say, that invest in both dividend-paying stocks and interest-paying bonds. And in that case, you're not really aiming for capital gains. If there are any capital gains, it really is a consequence. You really are aiming for vehicles that are generating a steady income that are being paid out to the client pretty much as they're received. The only risk with the income-based approach is that investment markets don't always pay the level of income that one desires. And This has been the case in particular in this last decade that we've lived in, where yields have been quite low. And I'm sure you've seen it as well as I have, clients walking through your door with DIY portfolios, where really the most conservative part of their portfolio, well, they've been stretching for yield to try to capture a little bit more return from that bond element of the portfolio, which in turn increases the risk that that income might stop in challenging times that we might see ahead. So some financial planners and wealth managers have, including our firm, have decided to take a more total return approach to their investment management. And in this sense, we invest in a more growth-oriented portfolio, and if there are any dividends and interest, well, they're just reinvested into the portfolio or the investment strategy itself. And with this, we can also add this element of the capital gains component I talked a few minutes ago, which of course means the client becomes less reliant on just the dividends or interest that the other part of the portfolio is generating, but at the same time, they become a little bit more reliant on capital gains, which of course, as we know, are inconsistent. So let me illustrate this. We call our retirement income framework the 3 buckets approach. When our clients need income, we simply fund it from bucket number 1. And at our annual reviews, we will revisit bucket number 3, and if appropriate, we'll sell the desired investments to top up buckets number 1 and 2, which means that we're creating a buffer for the client so that they never have to encash from the investment portfolio directly when retirement income is needed. In other words, they're never having to withdraw from the portfolio in a down market, because we've created a structure that allows the client to sustain their lifestyle for a number of years before they need to dip into their investment portfolio. Ultimately, the reality is that even for something as simple as a total return approach that combines together interest, dividends, and capital gains, there's a non-trivial amount of complexity in turning all of these moving parts into a steady, ongoing retirement income for our clients. Recognizing that while an investment portfolio might have a series of different returns from different sources, most retirees simply want to pay their bills the way they've been paying their bills for decades, with cash that simply turns up in their current account on a regular, periodic basis. So with that in mind, I think there are some key practical components that we need to think about when we decide to take a portfolio-based approach to the retirement income strategy. Let's go through a few of those. So firstly, cash. Just some questions for you guys. Will it be allowed to accumulate? What will be done to increase or supplement the cash position over time? And is there a better place for cash to sit rather than, for example, inside the SIP bank account to try to generate more favorable yields? And beyond having cash just to distribute to the retiree, will there be an additional cash bucket or cash reserve to try to smooth out the withdrawals from an inconsistent investment portfolio? Dividends and interest. Will they be swept to cash, distributed immediately, or reinvested for future liquidation? Withdrawals. What will be liquidated if additional cash flows are needed, either on an ongoing basis or for one-off expenditures? I mean, will there be a rules-based system in place to determine formulaically what will be encashed when? For example, from stocks when the markets are up, from fixed interest or cash when the markets are down? Accounts. From which accounts will the withdrawals occur? Especially given that retirees normally have a mixture of accounts like ISAs, pensions, and GIAs, etc. And finally, coordination. How would the withdrawals be coordinated in line with the client's ongoing tax planning? In other words, will the retirement withdrawals from all these accounts that we manage have to be dynamically adjusted to cater for other cash flow sources like state pensions, defined benefit pensions, buy-to-let income, etc.? In the end, the point is simply to recognize that some form of consistent policy is needed. Ideally one that can be applied consistently and to a wide range of clients and scenarios so that we can scale up the retirement planning operation within our businesses. And of course, once you've decided on the methodology of generating retirement income withdrawals, the next step is to evaluate the sustainability of the retirement plan. After all, in retirement, the focus of financial planning shifts from maximizing wealth to instead maximizing the likelihood of success and minimizing the likelihood of failure. But is the retirement plan with the lowest risk of failure really the best choice? Now, I'll assume that most of us in this room use some form of sophisticated financial planning software to illustrate our financial plans to clients. And whilst this alone is fine for accumulation clients, we all know that a straight line cash flow projection isn't the most robust way to stress test a retirement income plan. So whether you use Monte Carlo analysis or a historical data set for evaluating the sustainability of a retirement income plan, this additional layer of analysis can be used to frame the conversation with the client in terms of probability of success and probability of failure, rather than simply looking at how much wealth could potentially be left behind in a straight line cash flow projection. Yet, looking at that red line, the reality is that while failure from this perspective means the client ran out of money before the selected time horizon is up, in truth, most clients, at least most clients that work with us, wouldn't simply continue to spend down this unsustainable path right to the bitter end. Instead, the plan would be, if the plan was clearly heading for ruin, both the clients and us would start making the required adjustments. So, with this in mind, risk of failure is probably better termed as risk of adjustment instead. And when viewed from that perspective, it turns out that the plan with the lowest risk of adjustment may not be the ideal plan for the client to choose from. So let me explain what I mean by that. So in the process of digging into how we typically frame probability of success and probability of failure within a financial plan, naturally trying to maximize success and minimize failure, it becomes clear that there's an inherent danger in doing so blindly because of the simple fact that not all failures are the same, nor do they require the same level of adjustments to get the plan back on track. For instance, let's imagine a 65-year-old couple with a 30-year retirement horizon. So here are two plan options for you. Plan A uses a relatively equity-centric portfolio that has a 90% probability of success that the plan will be sustainable for 30 years. Plan B, it uses a more conservative asset allocation, and because it generates a lower average rate of return more frequently, it only has an 85% probability of success. So measured by probability of success alone, the answer seems pretty clear. Plan A fails only 10% of the time, Plan B fails 15% of the time, so Plan A has got to be the winner. And in a world where all failures are the same, choosing Plan A over Plan B would be the prudent decision. But the reality is that not all failures are the same. For instance, what happens if we look at one of the worst case scenarios within this analysis? So, Plan A, it's pretty ugly. Due to the heavy exposure to equities, a severe bear market is a rather destructive event. So if we look at the most negative scenario within this analysis, the hypothetical client actually runs out of money at age 81. In other words, while the client may have had a 90% chance of succeeding and only a 10% risk of failure, those failures are rather catastrophic, and the client could run out of money a whole 14 years early. And, if that rare but possible adverse event happens early in the client's retirement income journey, well, getting back on track would require some pretty draconian cuts to their standard of living. So in this case, failure may be relatively uncommon, but if it does occur, it requires big adjustments. On the other hand, Plan B has far less exposure to equities and far less overall volatility. As a result, an unfavorable sequence can't be all that unfavorable, and a below-average series of returns can't be all that far from average. Consequently, when we look at the worst-case scenario in this analysis, the client only runs out of money at age 92, which in turn means that the adjustments necessary to get back on track are relatively mild. So in other words, while the odds on that plan are higher that some form of adjustment will be needed, the adjustments necessary to mitigate the adverse scenario are far more manageable. And suddenly, when looking at this, the optimal retirement portfolio decision becomes far less clear. Because while Plan A has a higher probability of success at 90%, and thus only a 10% risk of adjustment, the consequences of those required adjustments can be harsh to fix. Plan B might have a lower probability of success and therefore a higher probability of adjustment because there's a higher failure rate, but the magnitude of the adjustment will be relatively minor, as the client only has to adjust for an extra 3 years worth of retirement income to achieve the 30-year time horizon that they were aiming for, even in a highly adverse scenario. So, in summary, it may be better to follow a plan that leads to slow failure, which can be easily fixed with modest mid-course adjustments, even if the slow failure scenario is somewhat more likely to require at least some adjustments in the first place. And it's also worth noting that most clients tend to slow down their spending in later years anyway, which means plans that cause slow failures and require slow, modest adjustments may simply move in sync with an aging client's declining cost of living. So the bottom line is this: while the benefit of stress testing a retirement income plan through, say, a Monte Carlo analysis is to focus on the probability of success and the risk of failure, when we look deeper at what failure actually means, the reality emerges that the highest probability of success and the lowest probability of failure may not always be the most desirable plan. Instead, we need to look at the whole picture. We need to look at both the risk of adjustment and the potential magnitude of those adjustments to be able to really understand the risks and opportunities involved. And, this is important because when it comes to retirement planning in particular, as we know, our brains are not quite the logical, rational decision-making machines we think it is. For instance, let's look at a phenomenon called substitution bias. If someone asks you, how popular will the Prime Minister be 6 months from now? Most of us don't actually go through the detailed analysis to project how changing trends will impact the Prime Minister's popularity down the road. Instead, our brains will take a shortcut, like looking at how popular the Prime Minister is now and simply projecting that into the future. Similarly, if someone asks you, how do you feel about your life overall right now? The research shows that you're more likely to take another shortcut and simply reflect your mood as it stands right now. So if your mood is good, you'll probably answer, life's pretty good. And if your mood is bad, you'll probably answer accordingly too. So in a nutshell, the research on, sorry, I missed the punchline. The research on substitution bias shows us that for some types of questions, the easier question we substitute may simply be one that reflects the current situation or environment in exchange for a future estimate. Now, with some kinds of abstract questions, we need to go a step further. It turns out that, It turns out that our brains are especially good at thinking in terms of intensity and relating to different scales back to a similar one that's based on intensity. So in his book, Thinking Fast and Slow, Daniel Kahneman gives a great example, which I'd like to run through with you now. Have a read of the statement on the screen. Julie read fluently when she was 4 years old. Now let me ask you this. How tall is a man who is as tall as Julie is precocious? Well, the research shows that when researchers ask this question to a group who understands and relates to contexts like this in a similar way, it turns out that most people will give a fairly consistent answer. So in this context, we relate it to some height that is as remarkable as a 4-year-old who can read fluently is also remarkable. And in fact, within a consistent cultural environment, the researchers can even ask other questions, such as what level of income in your profession relates to Julie's reading achievement, or which crime is as severe as Julie is precocious, and they'll also get fairly consistent answers. So the point simply put is this: we're quite good at relating comparative intensities on different scales and then translating it back to one. And at this point you might be asking yourself, well, okay, Amyr, but why is this important to us? Well, when reading through the discussions on how our brains evaluate difficult questions, it was striking to me that we often ask our clients to answer equally challenging questions throughout the financial planning process. And given the research on how our brains think, it's almost certain that our clients engage in a similar process, which is somewhat concerning because their answers to our questions can lead to some pretty distorted consequences. For instance, think about the Plan A and Plan B example I went through a few minutes ago. Imagine the situation where the client is asked to decide the probability of success that's acceptable to his or her retirement plan. And as the conversation goes, the client is asked which plan is preferable, one that has a 85% chance of probability of success, one that has a 90% probability of success, or indeed, would the client like to spend less or try to save more or perhaps retire later to achieve a plan with a 99% probability of success? But in practice, our brains have very little framework to really evaluate such probabilities. And in the end, we don't really know how to evaluate what a 90% chance of succeeding really means. Instead, the research shows that we're probably substituting this for an easier question, such as, how intensely bad would I feel about running out of money in retirement? And given our ease of converting intensity questions on different scales, the brain can pretty easily answer that question, evaluating the intensity of negative feelings about that potential adverse scenario. And it's pretty obvious that in retirement planning in particular, and with clients dealing with their retirement planning specifically, they're going to have pretty intensely bad feelings about running out of money in retirement. So the word failure is just going to make them require a higher probability of success for their retirement plans. Which is to say that the point of all of this is that how retirement risks, opportunities, and trade-offs are framed really impacts on the ultimate decisions that are made. If a client is considering a 5% withdrawal rate that has only a 90% chance of success and a whopping 10% risk of failure, well, that sounds pretty scary. Now, by contrast, if we frame it as a 10% risk of making modest mid-course adjustments and a 90% chance of leaving a potentially significant legacy, well, that sounds very different. And all this means is that we should continue to work on ways to evolve our analysis, to do a better job of showing our clients not just the outcomes of our analysis, but also the sensitivity of to the inputs that we used, so that clients really understand the potential impact of working longer, or retiring earlier, or changing their spending habits, or even potentially being affected by a downturn in the markets. And while these differences arguably are just semantics, I think how results are framed really matters. And it can really have an impact in real-world client behaviors, given the difficulties our brains have to try to assert probabilistic maths. Which means that, in truth, if failures simply require mid-course adjustments and successes actually leave behind excesses, well, perhaps it's time to reframe the way we position our analysis to clients by using the terms probability of excess and probability of adjustment instead. Which brings us to the point where we can start to wrap this all up together. So let's look at the concept of crafting a withdrawal policy statement for our clients. So similar to an investment policy statement, which I'm sure most of us are familiar with, the goal here is to articulate a series of guidelines about how retirement withdrawals will be funded from the portfolio to clarify how we will respond to a market calamity when it strikes, and in advance, agree on the steps that we'll take to make sure that the plan is back on track. So, what exactly is a withdrawal policy statement and what does it contain? Well, I first came across this idea in an article by a guy named Jonathan Guyton on the Journal of Financial Planning, or in the Journal of Financial Planning. And in that article, Guyton suggests that a withdrawal policy statement should contain 5 key areas. I'll talk you through them now. So the first one is, what are the client's income goals that are to be met via the withdrawals? Second, what are the client's assets to which the withdrawal policy statement actually applies to that will fund those income goals we've just identified? 3, what's the initial withdrawal rate? 4, what is the method for determining the source of each year's withdrawals from the portfolio? And 5, what is the method for determining the withdrawal amount in subsequent years, including the trigger points for adjustments, but also the magnitude of the adjustment itself? Now, I promise you this, if it sounds complicated, it really shouldn't be, and I wouldn't be leaving you high and dry with 5 bullet points. So this is Jonathan Guyton's 1-page withdrawal policy statement. And I thought it would be a good exercise if we could dive into it together. So let's look at the first section. Fairly straightforward. The first part starts by identifying the assets to which the withdrawal policy statement applies to. And you can see it there, initial assets, $1 million. It then breaks down the withdrawal income goals for the client, like the fact that the client actually wants to receive an annual income starting now and all the way throughout their life. The fact that the client wants those withdrawals to increase in line with inflation. The fact that the client wants to minimize the chance that they're going to outlive their retirement assets. The fact that the client wants to minimize any undue or unexpected changes to their regular monthly income. And of course, the fact that the client wants to structure the sources of these incomes or these withdrawals so that it's as tax efficient as possible. It then states the initial withdrawal amount, $4,500 per month, and it translates that into the initial withdrawal rate at 5.4%. Okay, so the next section. It looks at the method for determining each year's withdrawals. And it starts with a simple statement. It says the withdrawals are going to be increased by inflation based on the previous year's inflation numbers, unless. And then it gives us 4 caveats. So caveat number 1, unless the client decides they don't want to increase their income. Fairly obvious, but stated in black and white. B, unless next year's withdrawal amount would make the withdrawal rate more than 6.5%. And in that case, you reduce the withdrawal amount by 10%. So in plain English, unless the portfolio value dropped by so much that the withdrawal amount made the withdrawal rate 20% more than what it was in the previous year. And if that happens, if we just use the numbers he's been using, instead of $4,500 per month, it would become $4,050 per month. And bullet point C is the opposite. If the portfolio value has increased by as much, that the withdrawal amount now means that the withdrawal rate is 20% less than what it was initially, well, guess what? Increase the withdrawal amount by 10%. So again, using last slide's numbers, instead of $4,500 per month, $4,950 per month. And finally, neither B nor C applies if last year's investment performance was negative. If that's the case, just stick with the same withdrawal amount that you're taking at the moment. So really simple. The rules are set in black and white up front. Okay. The next section determines the sources of those withdrawals. This is thinking about the tax efficiency of the order in which things are withdrawn from what tax wrappers. And of course, if you read this here, you'll notice there's a little bit of American financial planning terminology like IRAs. We can easily translate that back into our mechanism here, or our language here. I mean, but it's still very straightforward. I mean, look, it says up front, interest and dividend distributions will be taken into cash and held inside the investment account. It's just stating what the mechanical process of those withdrawal sources are. And it goes all the way to say that the yearly withdrawals will be funded from equities when the markets are up, and it will be funded from fixed interest when the markets are down. And then it states the order in which you're going to actually access that money to make up the withdrawal amount. And finally, the document ends with a really simple statement, asking the client to confirm that they understand and agree with this standard operating procedure, if you will, for managing their retirement income plan. So I guess it's important to bear in mind that a withdrawal policy statement isn't a financial plan, but rather it's a set of guiding principles as to how you're going to manage your client's withdrawals given their income objectives. In other words, the goal is to have a financial plan up front and then a withdrawal policy statement or a standard operating procedure for how you and the client are going to react objectively rather than reacting emotionally when markets change or life changes along the way. So, in other words, at the end of the day, having a withdrawal policy statement turns the scary uncertainty of market volatility into a series of clear thresholds and specific action steps that you and the client would take to help manage the client's expectations and manage their financial plan so it can stay on track throughout their retirement. Okay, so to sum it up, what are the lessons that you can draw from my presentation today? Well, as I promised at the beginning of this talk, here are 3 takeaways for you to think about. Number 1, speak your client's language and understand your client's needs. As a growing body of research shows, our brains are not quite the logical, rational, decision-making machines we think they are. Instead, our brains take shortcuts, such as substituting difficult questions for easier ones. And this is especially problematic in the world of financial planning, where we often ask our clients to make difficult decisions with limited information. So, I guess all I'm saying here is ensure that you're giving the clients your full analysis and all the information they need, but also give them the context behind that analysis and the context behind that information so that they can make an informed decision. 2, establish your client's retirement income investment process. Let's think about this for a second. Imagine a prospective retiree who simply doesn't want to annuitize their wealth. Determining how best to invest a retirement portfolio to generate a steady stream of retirement cash flows is a substantial challenge, and that's where we can add value. So it doesn't matter which methodology you choose. I think whatever methodology you choose, we as financial planners need to be able to answer a number of important questions about the actual mechanical process of generating retirement income, including whether there's going to be a cash position, how dividends and interest are going to be handled, what are you going to do in terms of rebalancing in the up and down market scenarios, where those retirement income withdrawals are actually going to come from, and how that fits in line with the client's overall ongoing tax planning. And finally, have a standard operating procedure for how you run a retirement plan. While we as financial planners do our best to help our clients stick with their retirement plans throughout different market cycles, I would suggest that the best approach for doing this is to craft a withdrawal policy statement for your clients. Similar to an investment policy statement, the goal is to articulate a series of parameters and guidelines about how you will respond when a market calamity strikes. And it determines in advance what steps you'll be taking to make sure the plan is on track. And that's both for you, for your clients, and for your team, so that you can really scale up the retirement planning operations within your business. I showed you how Jonathan Guyton does it, and he shares that framework with us freely. I think it's a great framework. But what I think is even better is, I'm sure that amongst us in the room today, we can continue developing this framework to bring it more in line with what we need in the UK, so that we can ensure that our clients can achieve and then maintain the standard of living that they've been working so hard to achieve for themselves and their families throughout retirement. Thank you.